All right, let's dive right in. We're going to talk about the most common, totally predictable mistakes that new investors make. You know, the kind of slip-ups that can really mess with your success before you even get going. But the best part, they are 100% avoidable.
And this is so important to get. We're not talking about some random bit of bad luck here. These are patterns, predictable traps that can cost you real money and, maybe even worse, years of potential growth. But once you see them, you can just step right around them.
So, where do you even begin? Well, it's not with picking some hot stock. The real work, the crucial stuff, happens before you ever click buy on a single share. It all starts with making a plan.
And just look at this comparison. It's night and day, right? Without a plan, you're basically just winging it. You're reacting to the news, you're chasing whatever's hot this week, and you're probably taking on way more risk than you even realize. But with a plan, you've got clear goals, you have a timeline, you know exactly what you're comfortable with. It's the difference between using a GPS and just driving around hoping you end up somewhere good.
And this quote from Mike Casey just nails it. A plan is what actually sets you up for success. It's not about trying to outsmart the market, it's about preparing yourself so you can handle whatever the market throws at you. Now, part of that planning has to include something a ton of new investors completely forget about until it's way too late. Taxes. Seriously, they can be a silent killer for your returns, but the good news is you can use some pretty powerful tools to get ahead of them.
Using accounts like a 401k or an IRA is probably one of the smartest things you can do. Let's break it down real simple. With a traditional account, you get a tax break right now on the money you put in. With a Roth, you pay your taxes now, but then all of your growth, all of your withdrawals when you retire, completely tax-free. Which one's better? Well, it usually depends on if you think your taxes will be higher now or later in life. But either way, they are just fantastic for building wealth.
Okay, so you've got your plan. The next big hurdle? It's all in your head. It's this constant mind game every single investor has to play against two really powerful emotions: fear and greed. And let's be real, when the market's tanking and the headlines are all doom and gloom, it feels more than just uncomfortable, right? It feels awful. And that feeling leads to what is probably the most destructive mistake you can make: panic selling, usually right at the very bottom. So how do you stop yourself from doing that? You build a system to protect you from, well, you. First, put your investments on autopilot. That way you're consistently buying whether things are looking good or bad. Second, create a mandatory cooling off period. You get a hot tip or you feel that urge to sell everything? Make yourself wait 24, even 48 hours. It's a simple little trick that lets your logical brain catch up with your emotional brain.
Now, the other side of that fear coin is FOMO, the fear of missing out. You know the story. Your buddy at work is bragging about some stock that's gone to the moon, and you jump in, no research, terrified you're going to miss the boat. That almost always means you're buying right at the peak, just before it all comes crashing down. Fear and FOMO. They're just two different flavors of emotional investing.
All right, let's switch gears from the mental game to the nuts and bolts of actually building your portfolio, because there are two massive tactical mistakes that beginners make all the time.
I know, it's an old cliche, but it's a cliche for a reason. So many new investors just dump all their money into a couple of companies they've heard of, an Apple or a Tesla, and just cross their fingers. That is an incredibly risky way to go. The answer is diversification. It's a fancy word for a super simple idea. Don't put all your eggs in one basket. You spread your money out across lots of different investments to lower your risk if one of them goes south. And what's the absolute easiest way for a beginner to do this? Mutual funds, or ETFs. With a single purchase, you can own a tiny slice of hundreds, sometimes thousands of different companies. You're not betting on one company to hit it big anymore, you're betting on the long-term growth of the whole economy. That's a much safer, much smarter bet. So funds are awesome for diversification, but there is one hidden trap you've got to look out for, and that is fees. They're these tiny little percentages that don't seem like a big deal, but they quietly compound and eat away at your money year after year after year. So the big question is, how much is too much? Well, experts have a pretty good rule of thumb here. If you see a fund with an expense ratio over 0.4%, that's starting to get on the expensive side. Always check that number before you invest. So we've talked about planning, we've talked about emotions, we've talked about building your portfolio, but honestly, all of those mistakes are small potatoes compared to the single biggest error that keeps most people from building wealth.
That's it. It's that simple. The number one mistake is just not starting. It's paralysis by analysis. It's letting your cash pile up in a savings account earning practically nothing, waiting for some perfect time that, let's be honest, is never going to come.
And don't think this is some rare thing. As financial planner Dinon Hughes says, this happens all the time. People get excited, they open an account, they even put money in it, and then they forget to actually invest that money. The cash just sits there, literally losing value to inflation every single day.
And here's why that delay is so devastating. Every day you wait on the sidelines is a day you lose the magic of compound growth. Time is your single greatest asset as an investor. It's your superpower, and you can never get it back.
Look, at the end of the day, you don't need a fortune to get started. You can start today with $50. By just avoiding these common traps and actually getting in the game, you put yourself on the right path. So the only real question left is, what are you waiting for?